On behalf of CrossCheck Media and Biz Talk Today TV, welcome everyone to Hatfield Economics. I am your host, Todd Schoenberger. Joining me as he does every week is Jay Hatfield. He is the CEO of Infrastructure Capital Management and CIO of the ICAP ETFs. And Jay, breaking news that came out of your office early this morning. 5 a.m., I see a press release cross the wire. It's about infrastructure teaming up, collaborating with the Nasdaq for the first ever Nasdaq ETF. Jay, can you tell the audience about it?
Absolutely. Thanks for having me back, Todd. We're super excited about QVol. I grew up in the Silicon Valley. My mother was an engineer with Stanford, so I have a lot of friends. And our ETFs, a lot of our ETFs appeal to some of them, but most of the people back there only care about tech stocks. And so finally, ICAP, we have a fair amount of tech stocks, but way, way below the S&P 500. But here we have a great growth vehicle. And the other thing, though, that's super exciting is that everybody says, oh, NASDAQ 100, tech heavy, right? Well, actually, that's not true. It's just the 100 largest companies listed on the NASDAQ. So what do you get? You get Kraft Heinz, you get Pepsi, you get Comcast, you get Charter. And so we don't have those in our ETF, our QVol ETF, because we want to provide a vehicle to bet on the growth of technology and technology infrastructure in the US. And last I checked, cable is not likely to overtake Netflix anytime soon. And Pepsi is a great company and a little bit of a growth company, to be fair. Kraft Heinz, not really. So it's much more focused on true innovative growth companies. So the advertising that you'll see sometimes for the NASDAQ is a little bit misleading. It's as if they've curated all the greatest, most innovative companies, but they haven't. They're just selected the biggest companies. So we also, then the final thing we do is that we do screen for valuation. We don't want to overpay for companies. So we don't have any Tesla, don't have any Palantir right now. It has come in, but it's still expensive because that's a great way to blow up and destroy capital is buy overvalued companies. So our PEG ratio is just over 1. The NASDAQ's about 1.6. So reasonably priced companies growing quickly, great strategy. And then we have an overlay of writing bespoke calls on companies where we have a game where our models are showing they're pretty fully valued, very short term, so it doesn't cap our exposure to the market. Simple rule, if you carry less than market exposure, you underperform the market. If you don't believe that's true, look at the average hedge fund. There are hedge funds that do great, but most of them cycle their exposure. Like I know 72 Point does that. But other hedge funds are just long, short, very little market exposure. They always underperform the market. They're
go ahead.
investors that love that, but so you have to maintain the exposure. Sorry, go ahead.
No, you're fine. So you're collaborating with the Nasdaq. It only consists, the holdings consist of Nasdaq listed companies. And did I understand you correctly that you're mirroring the Nasdaq 100? You will have 100 positions in this ETF?
No, we will not. We have about just over 50 positions,
Okay.
but not too surprisingly because the bigger companies are dominated. Even though we've eliminated Kraft Heinz and some of the companies that you probably didn't want in your NASDAQ 100, it's still going to be 98, 99% correlated with the NASDAQ. So it's not like, we're not, don't have all the biggest companies. But we just eliminated the ones that most investors who buy the NASDAQ 100 didn't really want anyway and just happen to be there.
Yeah. And I assume you will have Netflix in the portfolio as
We do. Yeah, actually for a while we thought the cable was going to overtake streaming, but now we're thinking streaming is going to overtake cable. So we'll have Netflix and not have the cable companies.
Yeah, we at BTT believe that that's the case as well. And Netflix, I can understand it's up 3% today. Obviously, off of this great news, has the ETF launched?
It did. It launched this morning.
Okay.
And
so we can buy it now.
We can buy it now, and you can buy the dip too, because we are famous for poor timing, so we launched it on the day Nasdaq. Thankfully, Nasdaq's coming back, but this morning is down 300 handles. I was like, oh god. But thankfully, only our market makers took that loss. Hopefully, they're hedged, but it opened up like a couple bucks cheap. We launched it at 100, opened up at 98. I bought some around there, so opportunity to buy the Nasdaq down 2% from yesterday's high, at least.
Yeah, I mean, what a great time I mean, a great buying opportunity. So
Yeah.
obviously, so that is fantastic news. Well, congratulations to you and the team on this. I know that's a big accomplishment. Putting an ETF together is not
Last
easy.
point is that we'll pay $1 a month, so it's the 12% yield.
12% yield.
Yes,
That's remarkable.
So we're going to be very active writing calls, but very short term, so we don't cap the returns.
That's incredible. And you're able to buy, I assume, this ETF at all of the major wirehouses, the self-direct, et cetera.
Absolutely. Yeah, we tested most of them out using our PAs because this is a popular fund even at InfraCap because we have a lot of younger people, so they actually want to be in the Nasdaq as well.
That's great. And one final question for you. What's the ticker symbol in this ETF?
QVOL. So vol is for volatility. So great, another great ticker. Not
Okay.
as good as BNDS, but still a great ticker, QVOL.
QVOL, QVOL. That's awesome. Well, congratulations again. That's great news, Jay. Well, another piece of breaking news out of your office is the fact that you're actually raising your forecast for the S&P 500. You now have an 8,700 price target, but with one condition. Can you tell the audience about it?
Yeah, so we, as you know, like to use numbers when we have opinions. Unlike some forecasters, I think, I don't know, they don't disclose them at least. So at the beginning of the year, we had an 88,000 target, which wasn't that controversial. So it's higher than most strategists, but that was 23 times 27 earnings. And we just use consensus. A lot of strategists haircut consensus. We think that's not a good strategy. If you're going to haircut consensus, tell us which company you're haircutting, because we have models on most of the companies. So, and you can do the bigger companies and get most of it. So I think it's dumb to say, oh, I'm bearish in a market because I think the S&P is not going to earn what everybody else thinks. So we just use consensus. 23 times, though, the important thing is 23 times assumed a 375 10-year, because we do a discounted cash flow of the whole market. We assume a 5% perpetual growth rate and the 10-year, and we use 5.4%. That's what we used at Morgan Stanley. That's the 50-year average required extra return of the S&P. So every 25 basis points is one multiple. So we're reiterating our 8,000 target, even if the Strait does not reopen, because if the Strait does not reopen, we're definitely not going to get any rate cuts. Some people want to raise rates. Hopefully they're not dumb enough to do that. So we end up with a 10-year like right around here. I think we're at 435. Let's just assume that.
Mm-hmm.
And so that's consistent with a couple of multiples lower. So with 21 times the new estimate for the S&P next year is around 380. That gets you to your 8,000. But if you put 23, that gets you to 8,700. And I would say the way the market's acting, that even with the Strait closed, that probably 8,000 is on the low side. You know, keep in mind we have a kind of a normal seasonal sell-off today where earnings season's over, but the Nasdaq's, bouncing pretty hard. And we're at 7,400. So we're only 600 points away from our initial target. So that's, nothing. That's like 6-7%. We've got 3 earnings seasons to go. So we're not going to officially raise our target until we get lower rates and the Strait open. But I would just say that 8,000 target even feels too low, even with rates elevated and oil prices near 100.
So 8,000 target is the floor, even with the Strait closed.
Mm-hmm.
What happens? Let's take the long view on this one. Let's assume that the Strait does not reopen for the rest of the year. Mm-hmm. What does that do to equities and oil prices?
Well, I think oil prices could go to about 120, because the longer we are running down supply. Right now, oil price reflects some probability that the strait reopens and the price goes down $20 in a day, right? So nobody's going to get too long oil in that context. But reality does bite. Like in California, they're running out of supply. We're draining reserves globally. So we think it would trend higher. But the great thing about the US is we're a tech dominated economy. If you look at GDP last quarter, the tech component grew 15% on the investment side. And I would counsel everyone to be laser focused on investment as the key growth driver of the economy. Normally, when the Fed's tight like it is now, we have a recession because in the past, housing dominated the economy. It was more cyclical. After the great financial crisis, we stopped these big booms, which is actually good. And now we have this very unique technology boom where it's not just software and computers and a few software engineers. It's this whole huge infrastructure. That's why QVol is really an infrastructure fund, tech infrastructure fund. And that's just driving our whole economy. And the consumer's a little weak, so we're not bullish on consumer stocks. And we did lower our growth forecast to 2.5 with a straight close from 3.3. But more investment on the tech side, continued sluggish, really recession on the interest sensitive side, and a pretty sluggish consumer. A little bit more government spending because obviously there's a ton being spent on defense. So that all adds up to 2.5 growth still. So you just cannot derail this US economy. And we've also, I don't know if we've ever shown our chart, but you can get it on our website. The US is also an energy juggernaut. So we benefit when the straits close. We more competitive manufacturing wise. We have free natural gas, literally free in certain parts of the country. Huge advantage. We had inland sea that went through the United States. So we have an unlimited amount of hydrocarbons because hydrocarbons come from seas. So I wouldn't, even though we think the market's going to kind of flatten out in May, June, I wouldn't bail out, maybe trim a few. If you have Micron up 150% or something, might trim that a little. But stay invested because this is a great market in the long run.
Okay. Well, I love the optimism. I want to ask you your personal opinion on this, though. If we have Navy ships that are in that region, that we have this naval blockade that's taken place, why can't we reopen? Why can't ships just pass through? This doesn't make a lot of sense because how is it that the Iranians still have control of a region where they don't even have a navy?
Well, that's why we're a little bit disappointed with the current policy of negotiating with the Iranians. And, it's important as a security an analyst rather, to use common sense. Because you might say, well, you're not a military expert, Jay, but of course, none of us are experts on anything that we're analyzing and forecasting. If we were, we weren't be stock analysts. But
well,
so
not I don't mean to interrupt you, but not an analyst, but a very, very intelligent, high IQ Wall Street expert. I mean, you went to
well, we try to
Penn.
be, and also just try to use common sense, which
Right.
surprisingly a lot of people omit from their work. So our common sense says this has been our enemy for 47 years. We killed not only their leaders, but their leaders' relatives. And we're asking them to give up their holy grail, which is a nuclear bomb. And I just don't see why they're going to get an epiphany. They've been committed to destroying Israel and the United States for 47 years. Why, after we bomb them, all of a sudden they're going to be our best friend? So I would say a reasonable human, you could get 100 of them, 90 would say, yeah, that's not happening. So what we're doing is delaying exactly what you were referring to. We do need to bomb more of their missiles, more of their drone capacity, maybe put some troops on the shore with some anti-missile batteries, put more ships, get a coalition like the UAE is already fighting with the Iranians, get some of Europe. Rubio's working on that. And interdict. Maybe there'll be a couple hits, but get this flowing, maybe provide insurance. But that's our bullish scenario is we do it by force. We do it with maybe some ground troops, at least on the immediate ground, not like in Tehran. And maybe we have to black them out because that'll make it harder for them to attack us. But do whatever it takes to open up the strait, because this notion just seems to me ridiculous. Like, I don't wait with bated breath, like, oh, what is president going to say about the Iranian response? Of course, it's going to be unacceptable. So I think we're kind of wasting time. We were talking before we came on, we thought this would happen pretty quickly, but we didn't think we'd have these like 3-week pauses to try to negotiate with a group that has had no interest in negotiating with the U.S. for 47 years.
The one thing that has come up is that oil production is reaching max capacity in Iran. But wouldn't the same hold true in the UAE and in Saudi Arabia and Kuwait? I mean, aren't they reaching max capacity?
They have some issues, but they do. Both UAE and Saudis do have a pipeline that goes to the Red Sea. So that should be enough capacity to keep their wells operating. Because as you're pointing out, it is essentially a disaster to stop producing a well. The reason you frack it is to get it to flow.
Right.
You don't want to stop it flowing because then you have to potentially refrack it. So rework it over again. I know a little bit about this because I founded a energy company, and we're the main water carrier in the Permian. So you don't want to stop and start wells. So that is a real issue, but we think there's enough capacity through the Red Sea to keep the not Iranian oil running, but the rest of the Middle East producers' capacity running.
And on the oil topic, with an extended closure of the strait, or like you mentioned, we could be looking at 120 a barrel. What does that equate to for the average price of gas at the pump in this country? We're already over 450. I mean, we're going to only anticipate that it's going higher. I mean, are you thinking maybe $6-7 a gallon?
Well, let's see if we can do math in our head on the fly. So the only thing that mitigates, you would think, okay, well, if we're at say 100 and we go to 120, that's 20%. So gasoline goes up 20, but there's a dollar margin. So the 350 goes up 20%. So that'd be like 420. So you go to about 520. So in other words, the margin makes the percentage increase slightly lower, because the margin will expand maybe a little, but it's not going to go up 20%. So yeah, you easily get to 5. And California is pretty interesting because they're a little bit like a mini Europe. Like, they blew the energy transition. My grandfather rather was from Southern California. First stock I got was Union Oil of California. Well, guess why? They were drilling in Southern California. There's a tremendous amount of oil. They stopped all that drilling. So they're importing all their oil and refined products, not from the US, but from Asia, which has a shortage. So we don't have a shortage in the Gulf. But so what an unmitigated disaster that is.
That definitely is.
So they could be going to $10 well, there's never a shortage if you have a free market, right? So, like the price goes to 20, then people just don't use it. But like, it could mega spike in California, and which is ironic because they're sitting on enormous oil and gas reserves. They've been beating up on the refineries since I left California 35 years ago. So they're in serious, serious trouble.
Right. And I would imagine on your website, you probably have some type of an elasticity model to show that you mentioned 520. What is the downside then to GDP? You mentioned 2.5% growth, which is great. We need that. It's a healthy economy at 2.5%. But there's got to be an impact somewhere along the line in the second half of this year, which could greatly impact the midterm election season. But regardless, what is your number, though, that you think Americans are going to finally say, you know what? I'm selling the Subaru. I'm buying a donkey.
Well, the great news is during the 70s, gasoline was up to 8% of consumer spending, and now it's 3%. So it's a headwind. And We are avoiding most consumer stocks. Thankfully, we don't really follow a lot of consumer stocks because consumer products are not really infrastructure. So we try to be a little bit focused. So we're kind of naturally out of it, but we're not interested in any ideas in that area. But our 2.5 forecast assumed pretty significant deceleration in consumer spending, offset though by this tech spending. And the consumer really only rolls over, and this is a critical insight, and we have data on our website that supports it, when investment rolls over. So if you watch TV, which I don't recommend unless we're on, then everybody's always obsessing, oh, the consumer, their sentiment is bad, or their student loans are now being paid off, and they're K-shaped. But they don't look at the history and say, well, basically, the consumer has always consumed. They're like woodchucks chucking wood through most cycles. The only time they've ever gone negative, on average, they have not gone negative, is if you have a horrible, horrible decline in investment and big, big layoffs like in the great financial crisis. Because laid off consumers do not consume. But low-income consumers have to consume because they have to eat and they have to get health care. High-income consumers consume no matter what because they want to and they have enough money to. So it's just a juggernaut. It does slow down at the margin. So that accounts for about the 80 basis points of decline in GDP. But in the US, not a disaster. And here's the critical insight. Our natural gas has actually gone down since the war started. We're drilling more oil and natural gas, so we have more. And so there's an excess. And so our electricity prices and our natural gas prices don't go up. In Europe, they're doubling. Now that would be an unmitigated disaster. Because it's not just 3%, then you'd be more like 8% of consumption, and not just going up 30%, but in doubling because natural gas is more volatile. So rest of the world, not good. I would stick to US stocks, US tech stocks, some other stocks. But because this is not good, maybe there's not a lot of California-based stocks, but not good for California. But just people, I've been saying this for a while, and everybody kind of looks at me like I have two heads, but this doesn't affect the US very much just because of that inland sea and this tech boom.
Right. And speaking of the tech boom, semiconductors have been on a tear lately. The Philadelphia Semiconductor Index has just been shattering records every day, it seems. Today is obviously an off day. Do you still see leadership in the semiconductors, or do you think now is the time to start maybe looking elsewhere, perhaps in industrials and financials?
I think maybe it's a bit early for that. I don't think financials are going to work till the war ends.
Okay.
Because there's going to be, because it's important to distinguish, maybe we're correct, but that doesn't really matter if everybody believes we're not correct. Like in March, we were saying we're going to have a power rally in April. Well, that doesn't mean you should get long in March because we're not going to have a power rally until the earnings get reported. And so I think the fears about the consumer will weigh on the financials until we clear the straight. I think that tech is going to work like every other day. So that might end up being more or less flat. But I wouldn't just say semiconductors. I would just stick to infrastructure, not just because it's in our name, but these cloud computing companies. Like, I love this. I love the fact that the market's so irrational in the short run. Amazon reports 50 billion of new capex.
Yeah.
Everybody sells the stock. So the implicit assumption is this professional manager, so not the founder, a professional manager, Andy Jassy, who can be fired at a moment's notice. The implicit assumption is he's a blithering idiot. So he's agreed to $50 billion of more capex with no contracts at terrible returns. What's the chance of that? I would argue zero. No, what it really was, and we found out a month later, they put out a forecast. Well, of course, if you have a capital budget of 150 and clients come to you and say, well, actually, I want to spend another 50 billion, guess how much you're going to charge them? A lot, right? So huge returns. So it's not just the chip companies, although Amazon has a chip, Trainium, which is creating even more upside. But so anything with infrastructure, even software companies with infrastructure like Oracle, Microsoft, we're bullish on. Those may not work till they report earnings, but a little more controversial. but all of the infrastructure and the chip companies. I mean, I would rather have AMD at 40 times than Intel at 75 times. The um, the memory companies traded 6, 7 times earnings, but there is huge Mo. When the Mo breaks, they're gonna be down 5, 10, 15% in a day. So you might be long some call options or take profits with they're up 20% in a day, and just be aware that like the chances that we just rocket to 8,000 in May, June, I would say that's really low. And so maybe it's a little bit like you're playing poker, if you know how that works, and you're in Vegas and you count cards. You can't count cards in Vegas anymore, but and a whole bunch of aces come out of the deck.
Yeah.
You don't have to not play, but if you've had profit, just maybe play with less. So we're just saying, yeah, to that, if you were to make me guess, I'd say maybe tech bounces tomorrow, but maybe 3 days after that, there's everybody's coming out of the Mo trades. But I'm comforted by like Marvell trades at a peg ratio about 1.2. AMD's peg ratio is fine. Amazon's actually arguably super cheap compared to Walmart, at least, but even super cheap. We have a 380 target on Amazon. So we don't view this as a bubble and everybody was just being an idiot. And now they're getting getting their hands burned. It's just that we can't look forward and say, well, AMD is reporting tomorrow. Well, I'm bulled up about that. Let me get along to like, what is the catalyst for tomorrow? I mean, you're going to get NVIDIA and you're going to get a few earnings reports, but you have this war fears. I think the Kospi broke last night. So greed is for earnings season, fear, non-earning season. We're still super bulled up, but you can be a little bit cautious, take a few profits, maybe have a little bit of cash to deploy if we get a big rundown. But even today's action, big drawdown, pretty hard bounce, seems like more of a neutral market, not a negative market.
So I have heard the names AMD and Oracle, like you mentioned, as really winners to really keep an eye on, and they seem to be growing in popularity as far as the amount of people that are behind them from Wall Street. I have one final question for you, though. The president is headed to China, and he's bringing along, I think it's 12 CEOs that he's bringing. NVIDIA is not one of them, and neither is Goldman Sachs. But do you expect any blockbuster deals coming out of that summit that we should keep an eye on?
Yeah, just a quick point on Oracle. I think
Oh,
people got too negative about it. Same deal. The CapEx leads to earnings. We don't think they're going to have a lot of CapEx or net CapEx. Just quick point. On China, I would imagine that if the meetings go well, that Boeing would get some big orders. They're easy to give orders to because they have a duopoly. We'll see what happens with NVIDIA on the chip side. I think Apple's pretty well positioned there, so it should be net positive for Apple. So the president's a deal maker. He's going to want to carry away some chits out of the meeting. So on net for those China exposed companies, Starbucks maybe at the margin, probably positive. And thankfully, I don't think Trump really wants to pick a fight with China. It's got plenty going on in the Middle East. So we think it's a minor positive. And maybe, that's the catalyst tomorrow that everybody gets excited because of China. But so we're not negative. We're just saying that it's not as easy money. Like we thought it was super easy money and to be long during April. Now maybe it's a little bit more dicey.
well, we do have some negotiating power here because the strait is closed when it comes to oil. I'd imagine they're starting to run out of their reserves in China. So there might be that. And who knows? I mean, maybe there's some other
It could be
deals that
good for
are,
Cheniere. There might be a LNG announcement. I mean,
yep.
all these things are a little bit PR because energy is fungible. So it doesn't really matter whether Cheniere sends it to China or Europe, but it sounds good. The airplane orders do matter. Good relationship with China matters for Apple, matters for Starbucks. So it's an important country. But like I said, I think that Trump's kind of lost his desire to pick a fight with China at this point. And so I think it's going to be a net positive. Maybe it'll distract a little bit from the Iranian situation.
Yeah, I mean he is speaking quite highly of it. Sounds like he's looking forward to it. His suitcase is packed, I'm sure, and he's ready to roll. So maybe he'll send us a postcard, but it's going to be interesting to
Hopefully
see.
it's positive. We need some positive during this earnings dearth.
Yes, no doubt about that. I completely agree with you. All right, Jay, we're going to leave it there. I know we're going to talk again next week. Guarantee there's going to be a lot going on. We still have to really break down the inflation data. We have PPI out tomorrow. We could talk about that next week. And obviously, the results of the China meeting and see if anything positive came out of that. But I do appreciate you joining me today. I know you're very busy, especially with that ETF. One more time, what's the symbol?
QVOL, QVOL.
QVOL. That's right, everyone. You want to go out key and QVOL. We'll have it right here on the banner as well as in the description of the show. Definitely want to check it out and consider it for your portfolio. So, Jay, thanks again for joining me. I can't wait to see you again next week.
Thanks, Todd. Those great questions.
Thank you. So, on behalf of Jay Hatfield, I am Todd Schoenberger. Thank you once again for joining us on Hatfield Economics. We'll catch you next time. Take care.
There were a lot of nuances in that report, the inflation report, but we can get into it later.
Well, my thought is this is that the